What are Basel norms? What are Basel Accords? Basel norms are nothing but they are the international regulations. Why were these international regulations there? To ensure that the banks, they have enough capital, because banks, they are going to expose themselves to various kinds of risks. So do banks have enough capital to protect themselves from those risks, right? To cover their risks. Now, in case if this thinking has started, then something must have happened which has led to this thinking. And who has given these norms? It was the Basel Committee on Banking Supervision, which was set up in 1974. Why Basel? Because, the committee was there in Basel, Switzerland. Why was this committee set up? Something must have happened. So that something was, there was a banking crisis which was going on. And what triggered that crisis was that there was a bank which was called Erste Bank in Germany in 1974, and it collapsed. When that bank collapsed, what was fearful at that time, that the failure of this bank is going to have a rippling effect on the other banks also. There is a possibility that the other banks might also fail, because all banks were connected with each other. That was the main problem. So the failure of one bank will start having a rippling effect on the other banks. Second reason, we needed to have a certain kind of harmonized supervisory standards. Actually, at that time, in certain countries, the banking regulations were very lax. But in certain other countries, the banking regulations were very strict. So certain banks used to take the positions in such a way that they can take advantage of those countries in which the banking regulations are very lax. So they can get an arbitrage profit because of that. And this was leading to a problem. So they said this, that why can't all the banks in the world, they should follow certain supervisory standard. All banks should follow the same supervisory standard. So nobody can take an advantage of any lax regulatory framework. So these were the reasons which triggered the formation of the Basel Committee. And then the question which is going to arise, okay, you are saying that banks expose themselves to various kinds of risks. What kind of risks? There were three main kinds of risks which come up. One of the risk is the credit risk. The other risk is the market risk. And the another risk is the operational risk. What is a credit risk? Supposedly, I'm a bank and you guys are individuals. I have given you certain amount of money as a loan. You default. So that is an individual credit risk. Supposedly, I'm a bank and you are a very big individual to whom I have given a huge amount in the loans. So my loans have concentrated on one individual or one kind of firm. That is also another kind of credit risk. Supposedly, I am a bank and you are a certain kind of firm in some country. And I, being a bank, I have given you most of the loans to your country only and to your firm only. This is leading to country risk. So I have exposed myself to the credit risk. Why credit risk? Because I've given credit to you and I'm exposing myself to these risks. The another kind of risk is the market risk. Market risk is going to arise when I am going to take up positions in the market. What kind of positions I'm going to take up in the market? I can take up a position. So for example, I say that, okay, I am buying a forward contract and the interest rate is going to be this in December. Let's going to buy that. But actually interest rate came out to be lesser. So maybe I'm going to face a loss. So that is an interest rate risk. Supposedly, I get in a forward contract, the commodity prices are going to be this in December, but they came out to be very high. I cannot buy them. So I have exposed myself to what is called commodity risk. Supposedly, I am a bank and I have taken a position that the US dollar is going to be this amount in December, but it actually came out to be lesser than that. So that is a currency risk I have exposed myself to. Equity risk is I have taken up certain position in the stocks and the stock prices, they are not matching up to my expectation. I have exposed myself to the equity risk. There is another kind of risk which comes, which is operational risk. Now, operational risk can be there. Supposedly, there is an internal fraud. Who is going to do internal fraud? My own employees can do internal fraud against a bank. I mean, this is always there. Or they can be external fraud. Other people external to bank can do external fraud. Legal risk could be there. Supposedly, some kind of legal framework has come. Now, that legal framework, although that has come, but it is not matching up to my expectation. So it is going to create a loss for me, at least in the short run. I have exposed myself to the operational risk and I can't do anything about it. Maybe a compliance risk. Some kind of judgment has come. Now you have to comply with this regulation that you have to pay tax from this date to that date at the higher rate. I have exposed my this and I mean, we need to be ready for all this. So the main idea was that if I am exposed to these many risks and I am taking money of the depositors, which I am liable to pay whenever they are going to ask me this money back. So have I created some kind of security? Have I created some kind of, created some kind of security? You can say that even if these risks are present, then also I have enough capital with me that I can pay back these depositors, right? Because any bank will be exposing itself to these kind of risks. There is no possibility that you can have complete security ever. The only security you can have is that you should have enough capital to cover these risks. You with me? So this was the main idea. Now what happened? There was Basel I Accord, Basel II Accord, and Basel III Accord. These accords means meetings, and these are called accords. Right? These were called accords. Now, what was Basel I Accord did? The main thing which Basel I Accord focused on was the credit risk. That do banks have enough capital with them to cover their credit risk at least? That was the main thing. That was a thinking which came at that time, right? And you know what? I mean, people, when you had enough capital with you to cover at least your credit risk, it means it is going to provide you with some cushion. That even if you are exposing yourself to the credit risk, because what banks will do? Should not banks give loans to the individuals? They will always give, right? But banks can only ensure that they have enough capital to cover their credit risk. That is the only thing which they can do. So that was Basel I Accord. I'm telling this very, very simplistically. There are so many issues even in this. Basel II Accord. So Basel II Accord was little more stringent than Basel I Accord, right? So it made certain more detailed rules. What kind of rules? So there were three pillars. So one of the pillar was minimum capital requirement. Now, in this in this Basel II Accord, the other risks were also included. Not only credit risk, but operational risk, market risk, all of that was there. So do you have a minimum capital to cover all these risks? That is what minimum capital requirement is. The another pillar was the supervisory review process. What do you mean by this? So it ensured that the regulators review how well the banks were ensuring that they have enough capital with them. That was there. Pillar 3 was the market discipline. I'm a bank. I mean, I have taken your deposits. Why do you think I have taken deposits? That I have taken up these deposits so that I can invest it somewhere and earn money. No? Or I can give these deposits to some other person who has come to me for loan. But the market discipline tells me, now you bank, you will have to tell to the market properly how much loans you have, what is the amount of credit risk which you had earlier, what steps you have taken. So making more information public. That was an idea. That was an idea. And the impact was that it created more transparency in the banking sector. So the impact of Basel I was it was providing some kind of cushion to the banking sector. Basel II Accord, it said that it created certain kind of transparency in the banking sector. Then you have Basel III Accord. This came after financial crisis of 2008. This came in 2010. So it said this, that banks should have more capital and in fact cleaner capital. And there were certain ideas there. The main components were the higher capital requirements. So banks should have more and a better quality capital. You're taking capital from whom? That is also important, right? Leverage ratio. Leverage ratio is that supposedly you are an individual and I am a bank. I will be giving only this much of loan to you. So it sets a limit to how much of loan I can give you, right? There is a maximum limit which it sets. Liquidity requirements, right? So liquidity requirements are that it ensures that the banks can survive the short-term financial stress if they have enough liquidity with them, right? So requiring them to hold enough liquid cash with them. That was the liquidity requirement. So these were in nutshell what the Basel norms were. So this gives you some introduction about the Basel norms. So of course, there are many things to be discussed in all of these points, but this is just a gist of what is Basel norm, why was this committee set up, what exactly this committee did, and what kind of risks banks expose themselves to, and what are the three Basel accounts, right? So I hope it was useful to you. Thank you, Dr.